How to account for depreciation under GAAP. Have you ever wondered how businesses keep track of the value of their assets over time? Understanding depreciation is key to grasping how companies manage their finances. Let's break down how to account for depreciation under generally accepted accounting principles. Depreciation is the process of allocating the cost of a tangible asset over its useful life. This means that instead of recording the entire cost of an asset in one go, businesses spread that cost over several years. This approach helps in accurately reflecting the asset's value on financial statements. There are four main methods to calculate depreciation. The first method is the straight-line method. This is the most straightforward approach. You take the cost of the asset, subtract the estimated salvage value, and divide that by the useful life of the asset. This gives you a consistent annual depreciation expense. Next, we have the declining balance method. This method calculates depreciation based on a percentage of the asset's current book value. It is often used for assets that lose value quickly in the early years. A popular variation is the double declining balance method, which accelerates the depreciation even more. The third method is the units of production method. This method bases depreciation on how much the asset is actually used, rather than just time. For example, if a machine is used more in one year than another, the depreciation expense will reflect that usage. You calculate it by taking the cost minus the salvage value and dividing it by the total expected units to produce. Lastly, we have the sum of the year's digits method. This method also accelerates depreciation. You calculate it based on the sum of the years of the asset's useful life. The depreciation expense is higher in the earlier years and decreases over time. Now, how does this all fit into bookkeeping education and reconciling bank statements? Accurate accounting for depreciation ensures that financial statements reflected the true value of assets. This is important for cash flow and financial ratios, which are reported in bank statements. If depreciation is not recorded properly, it can lead to discrepancies in financial reporting. In terms of GAAP compliance, it is essential to apply these methods consistently across similar assets. This consistency helps maintain transparency in financial reporting. If a method significantly impacts financial results, it should be disclosed in the financial statements. By understanding and applying these depreciation methods, businesses can maintain accurate financial records. This is not only important for internal management but also for compliance with tax regulations. So, whether you are a business owner or a student of bookkeeping, knowing how to account for depreciation is a fundamental skill that will serve you well.